Well, let's get to the next management then, that of REC. Mr. Harsh Baweja, the Director of Finance at REC, joins us to talk about the impact of RBI's new project financing norms, rate cuts, as well as the outlook for the remainder of this fiscal. Hi, Mr. Baweja. Thanks a lot for joining in. Well, it was definitely a relief that came in from the RBI when we looked at project financing norms. Help us out now. Help us decode some of these final guidelines. How do you read this? And more importantly, how will it impact your business as well as your capital ratios?
As far as REC is concerned, since this is not coming retrospectively, this will be prospectively. So ultimately, our the book up to 30th September 2025 would be governed with the existing rules, and this will be applicable to the financial closures to be done after 30th September 2025. So it will have a very insignificant effect on the balance sheet of the company. Reason being that as of now, my provision on the standard assets is already 0.94%, whereas the RBI has mandated the minimum 1% provision for the under construction project. So we don't think that this is going to impact our balance sheet. Number two, NBFC's accounts are basically governed by the India system, and whatever additional provision, if there is on account of RBI provisioning are there, that is routed through the impairment reserve account. That doesn't affect our PAT basically. Number two, the guidelines says that total provision of 1% on the under construction assets is to be made. So in case if I do the financial closure of any of the asset in the Q3, then the provision will have to be made progressively based on the disbursement to be made in the quarters to come. So it is going to make any effect, very insignificant effect in the books of accounts, and that will be done only progressively. And simultaneously, I can say once that asset achieves the completion, then the extra provisioning made will be reversed to 0.4%. So ultimately, this will be a continuous business after the March without affecting my previous business, which has already been done.
Okay, got that, sir. Now, your company reports low credit costs, right? But as a key market player, do the final guidelines also indicate that RBI does not see increasing risk in project financing? And can we expect that for your business as well?
As far as my credit costs are concerned, that is already at a very low rate, and we make a provision of 0.4% of my stage 1 assets and 0.5% of the stage 2 assets. For under construction project, as I have already explained you, for the new projects, we will have to make an extra provision. But having said that, if you see my numbers of the 31st March 2025, I am already at the level of 0.95% of my provisioning in the standard assets, stage 1 assets. So perhaps we don't see much of the impact on the ECL numbers and the credit costs in the near future, sir.
Okay. Mr. Baweja, another tailwind perhaps is, of course, the rate cuts. We're in a downward rate regime. So how will this impact your spreads? Any internal assessment that you have done for the business? Maybe if you can give us some sense of margins.
As far as the RBI's rate cuts are concerned, we have yet to see the impact coming to the market. Since if you see the bond yield, which has been happening for the last 2 or 3 weeks, even post the rate cuts, there is not much of the rate cuts in the bond yields that is coming in the market. Rather, before the rate cuts, REC could raise one of the cheapest source of funding through the institutional bonds. But in the recent times, say within last week or so, the bond yields have gone high. So we have yet to see the impact of that and the impact of the CRR, which is to be done in progressive manner. But yes, some insignificant effect in my cost of borrowing will always be there, since whatever fresh borrowing is coming, that will be coming at the reduced rate. And we think that our guidance regarding the NIM, we have given a guidance of around 3.5% to 3.75% and a spread of around 2.75% to 3%. We hopefully see that we would be able to maintain this range within this range. and we'll monitor it quarter by quarter. We see that impact further coming up in the market.
All right, so let's get back to the guidance then that you've given. I think around 12% loan growth. Last year, the numbers impacted because of higher repayments. How much of repayments do you expect this year, and what kind of loan growth should we be factoring in?
Since we are into an NBFC business, we will have to understand that prepayment is basically prepayments are the part and parcel of the total business profile. You cannot ignore the prepayments. Number two, in case if any of the agencies making prepayment to us, it means those agencies are the sound parties, sound clients. And if my clients and my the loan books pertains to the agencies, those over the sound books, sound agencies, that in that case, I can say that my balance sheet is also very strong. So prepayments will keep on coming. We are not afraid of that. We treat it as a part of the regular business activities. But yes, we expect that our AUM will grow at the rate of around plus minus 12%. And quarter on quarter, we'll see the progress, what is happening, what is the percentage of prepayments are coming up. Since one of our products, that is revolving bill credit facility, that in itself has the characteristics that agencies, whenever they have the surplus, they can make the prepayment even without the prepayment charges. So that prepayment will keep on coming, and that will affect our loan book also. But keeping that aside, rest are the very insignificant amount. Some of the amount had been made by the prepayment by one of the borrower who had raised the fund through their IPO proceed. Similarly, one of the big borrower had made the payment to make their headroom available for their new sanctions, then they had reached the exposure level. So these type of cases will continue to happen. And we expect, despite all these things, that we should be able to maintain plus minus 12% growth.
Okay, all right, got that. Mr. Baweja, finally, we are in Q1. What should investors expect from REC as this year rolls on? Any sense of how so far business has shaped up in this quarter, growth trends, yields, anything you can leave us with?
Quarter end is not very far off. Let us wait for the quarter end to be completed. We are working very hard on all the aspects. We are focusing on improving our quality of the books of accounts and quality of the assets. We expect that by the year FY26, we will be a zero NPA company, and some of the assets are at the advanced stage of resolutions. Disbursements are absolutely on the same track. In case if the prepayment doesn't happen, that it should be on the same target as we expected earlier. And as of now, for this quarter, we don't expect any effect on the NIM and the spread. That may be continuously on the guidance. And we say that since we are in the financing business, we should keep on reviewing every quarter. What is the impact? The things are changing very fast. So market is moving very fast. 15 days before, the yield rate was different. Yesterday, the yield rate bond yield rate was different. I am raising fund from the market. Even the international market is different. We have raised from the ECB markets. The rates which were available at the end of the March are very much different, the rate prevailing as of now. So we have to review it, and we have to focus on each and every day and each and every quarter, and we'll keep on reviewing. But yes, as far as the borrowings are concerned, on the date of requirement, we don't want to keep any funds idle. But yes, on the date of requirement of the fund, which source is cheaper to us, we go for that kind of funding so as to arrive at the good cost of borrowing.
Well, thanks a lot, sir, for joining in and giving us a sense about the impact of RBI's changes, as well as some sense about business. But we look forward to chatting up with you at the end of the first quarter numbers and get a further sense about the year ahead.